Hi viewers, welcome back. In this video, we are going to learn about what is private equity. Before going to that, let me ask you a question. What is public equity? Public equity is the equity which is listed on stock exchange. Whenever the company wants funds, it has two routes, either to go for private equity or public equity. Whereas in public equity, the equity will be listed on recognized stock exchange. If it is a private equity, other case, it is not listed. Keeping in that mind, we are going to learn more detail what is private equity. To get basic understanding of a private equity fund, see in this video we are going to cover more detail related to the private equity fund. When it comes to private equity, equity created in the company by securing funds from the private players. Either it may be a private fund or either it may be private single investors. You can see there is a lot of wealthy investors, example like Rakesh Jhunjhunwala or Warren Buffett. They themselves can provide the funds, or funds can be provided through private equity fund, where fund collects amount from lot of wealthy investors. In coming slides we can see who are the investors providing fund to this private equity fund, which in turn ultimately goes to the company. So in this video we are going to cover more detail related to private equity fund. So you have to get the basic understanding of private equity fund. You need to find out answers for the following questions. What is private equity definition? Structure of private equity fund, life cycle of private equity fund, who are common investors, where do PE funds commonly invest, how stakeholders of the fund earn money, how PE funds liquidate its investments. So once you understand all these 7 points, I think you will get a basic understanding of what is private equity. So let us start our answers to all these questions. So let us try to understand what is private equity definition, which is given by Investopedia. Private equity is an alternative investment. In my previous video, I covered what is an alternative investment. You can watch that video if you want. I'm giving link in the description. So private equity is an alternative investment class and consists of capital that is not listed on a public exchange. If it is listed on a public exchange, it is termed as public equity. So private equity is capital that is not listed on a public exchange. Private equity is composed of funds and investors. So, as we discussed, private equity, in private equity there may be private equity fund or either a single investor can provide funds. So private equity consists of funds and investors that directly invest in private companies. So we can also see in coming slides where they invest, or that engage in buyout of public company resulting in dissolution of public equity. Institutional and retail investors provide the capital for private equity fund, and the capital can be utilized to fund new technology, make acquisition, expand working capital, and bolster and solidify business balance sheet. So this is the definition given by Investopedia. You will get a more clarity once we cover the entire video. So now let us answer our second question. How private equity funds are structured? So typical private equity firms are structured as partnerships. So most of the private equity firms are runs like a partnership, where there will be one general partner and all other investors are called as limited partners. General partner is the one who is from the private equity firm side, and all limited partners are the investors. The liability of limited partners is limited to the capital contributed, whereas liability of general partner is unlimited. When it comes to duties, limited partner invests in limited partnership, whereas general partner runs the limited partnership. So the duty of general partner is to run the fund, the duty of limited partner is to bring the funds, in short. Now let us see our next question. Life cycle of private equity fund. See, according to the Blackstone Private Wealth Solutions Group, you all know that Blackstone is the leading private equity firm in the globe. It says that the life cycle of the PE fund is typically 7 to 10 years and is generally broken into 3 stages: fundraising period, investment period, and harvesting period. Fundraising period might take 1 to 2 years, and investment period also might take some other 3 4 years, and last 2 years they might find the ways to liquidate all those investments. So here 2 points are worth noting. One is PE funds are closed-ended funds and they invest for long-term purpose. See, the life cycle of the fund is 7 to 10 years. If it is an open-ended fund, after 1 year, you may go to the fund and ask for withdrawal. But it is not possible because they have invested for long-term equity. It is not possible for selling your own stake and liquidating that only portion of one investor's stake and giving back to you is not possible, and it won't be profitable for overall fund wise also. So these funds will always be closed-ended funds, and mostly they invest for long-term equity. Now we are going to see who are the common investors in a private equity fund. Who provides a capital corpus to the fund, which in turn funds will invest into its objectives. See, these are the common investors who provide corpus to the fund. Those are all, you can see that all these are the institutions or investors with a lot of money. So, and they should earn some interest on they have the responsibility to earn some interest on the money they are having and give to their respective stakeholders. So private equity is one of the choice option available for making the investment for all these common investors. So let us see who are all those. They are public pension funds, corporate pension funds, insurance companies, high net worth individuals, family offices, endowments, foundations, fund of funds, sovereign wealth funds. A typical private equity firm will have all of these people, any of these people as investors who provide the corpus to the fund. Now we can see where do PE funds commonly invest. See, a private equity fund, as we covered in our previous slide, they invest for long-term equity. They will mostly purchasing equity of unlisted companies, preferably in startups. They will find the good startups which is having high potential, high sales growth, and very good profitability, very market size. They will find all those factors and they will invest in the equity of those startups, and they will also invest in real estate and infrastructure, and they will also go for leveraged buyouts, and they might also go for venture capital where they will be providing capital in initial stages of the business. And here you can see how they will structure their deal. They might go for common stock or preference stock or convertible debt. See, all these are the ways where the private equity can, through the route, which route they can pump their funds to the companies. Now we can see who are how the stakeholders of the fund earn money. See, as we have seen in the structure of the fund, it has both general partner and limited partner. How general partner earns money is through two ways. One, management fee, and another one is profit share. Management fee is calculated as 2% on funds managed. See, if the total investment is 100 million, so 100 million is funds managed, on the 2% will be calculated and will go for management fee. Whereas profit share is calculated as percentage of total profit earned minus commitments. See, commitment is you have to give certain preferred return to the investors. If it is 8%, so if you earn 1 million profit, 8% will go to investors and the remaining will be shared according to the profit share. So these are the two which general partner earns the money, and how limited partner earns is solely through profit share. Whenever the fund sells any of its investment, it will pay the preferred return to all the investors who are limited partners, and there is also, after the preferred return is paid, the remaining profits also will be split between general partner and limited partner in the respective profit sharing percentage. Now we can see our last question: How PE fund liquidate its investments? We can see 4 ways here. One is private sale to a financial investor. Another one is private sale to a strategic investor. Sale as part of IPO, initial public offering. Sale to promoter group. What is private sale to financial investor? There might be some interested investors who is having a lot of money, like Warren Buffett. You can see he has a lot of interest to purchase that company, so you can make a private sale to that financial investor, or private sale to a strategic investor. Strategic investor is who is having interest in that business line and who want to take over the respective competitor or respective business which is like providing raw material to this business, or it is a connection business. Strategic investor is the investor who is having business interest. And another one is sale as part of IPO. You all know that company will go for IPO, where the shares of this private equity firm will be sold along with shares of promoter. And one more option is sale to promoter route. If you are unable to liquidate your investment by any chance, then you will include one clause when you are making agreement with the company that if I am unable to liquidate my investor, you have to purchase my investment. So there will be some clause like promoter has to purchase the investment of the PE firms, so that PE firm will not enter into any losses. Yeah, viewers, I think you have got the idea of what is a private equity fund now. Thank you for watching the video.